Well, thank you so much to all of our listeners and viewers who are tuning in for this week's episode of Mortgage Matters with Chris. Chris, you have so much knowledge on credit and how it affects getting not just mortgage loans, but really any loan in general. You've got 25 years of experience in the industry, and so you have seen, credit scores of every kind. You've worked with every kind of client and buyer, and you've got lots to say on this matter. So I just want to say real quick, we were at a meeting earlier this week, and someone had shared a new graphic on debt levels in the U.S. And I thought that was interesting because, we had pre-planned to talk about credit scores and to share with our audience tips on how to get their credit scores up and, of course, maintain good credit. But seeing this graph of how high consumer debt levels are right now, I think just adds to why it's so important that we're talking about this.
It is.
That
With
is,
the cost of goods right now, people are, they're borrowing against everything because everything is so expensive, from gas to milk to eggs to just living. Living is expensive. And with the way the Fed fund rate keeps increasing the rate, now credit card interest rates go higher. So now the money that they're borrowing is higher. So it's really putting people in a position where their scores are dropping.
yeah.
So it's something you need to be very conscious of, especially if you're going to be in the market soon to buy a house.
So, Chris, can you explain to us how your credit score will affect you if you are going to buy? In this case, we're going to talk about buying a house, but of course, this applies to a lot of instances. Not everyone has bought a house before, so not everyone's been through the process. So can you give us an overview?
So a few things. So a lot of times people, most of you out there listening, including myself, we have Credit Karma, Experience. So you're getting your consumer credit scores. That gives us a good idea on where your score is going to be, but that's not the ultimate score. So it's a good thing to watch that because that's your consumer score. When you go buy a car, their algorithms are a little different. So their scoring system's a little different, but it gives us a good indicator. The mortgage algorithms are different, but however, you tell me you have a 740 with Credit Karma, I know that we're at least in the ballpark, give or take 10 points here or there, depending on which way that it goes. So the credit scoring system is very important, especially depending on the loan program that you're doing. So if you're looking to buy a house that's over, so you have two main loans. Let's just talk about the two main loan programs that we're going to talk about is government loans and then your conventional loans, your conforming loans. So you got Fannie and Freddie, and then we have our FHA, VA, USDA, our government loans. So credit-wise, when you go with a conventional loan program, the better the score, the better the rate. So really anything over a 740, you're going to get the best rate that you can. And in a lot of cases, people want to go conventional because maybe they're putting 20% down, so there's no PMI, and they want to maximize the opportunity to get the lowest rate. So it's going to be very helpful for them to have the better FICO score. Along with, even if they're putting less than 20% down, your PMI payment is affected by what your score is. You're graded on your credit score. So not only will your payment on the mortgage be higher, but your payment also with your private mortgage insurance that's on the back end of your loan will be hurt if you have a lower score. So that payment will be higher. So those are the two things. And when you're talking about dealing with some of the government loans, they're a lot more lenient as far as credit scores are concerned. VA loans, FHA loans. So not necessarily gonna hurt you rate wise, but then if you are the person that's putting 20% down, with an FHA loan, you're going to have a mortgage insurance payment with it no matter what. So your best program would have been in that case would be to go conventional to avoid that. And those MI payments or mortgage insurance payments are prorated. So those are a few things that, you have to take into consideration. So that being all said, the best thing is to prepare ahead of time. Make sure we do some certain things to boost that score up as high as we can on the front end of it, so you can then in turn get a better rate when you go to buy a house, buy a car, or purchase really anything anytime that you're going to, use credit. So when whoever's going to pull your credits report to grade you on based on how they're going to lend you money, we want to be good stewards with our money on the back end. So if you could, Mindy, I just want to show everybody how the credit works. And that way I can share with you guys that are watching this. And I'm going to also explain it in depth for those of you that are listening to it on the podcast, so you have a good understanding. But those who are on the Facebook, on my feed here, they can kind of see this at the same time. So how does the FICO credit scoring system work? And how are they weighting the factors? So I'm going to go just drop this. Wish I could bring it here. So if you guys see me looking up, I'm just looking at the screen that you're looking at. So I'm not looking off into the distance. But so here's the things. One, there's 5 buckets that we look at that are going to determine where your scores are, right? So the obvious one is always payment history. So your payment history, we know if we don't pay our credit cards on time or our vehicles or anything that's reporting to the credit bureaus on time, it's going to hurt our score. That's the obvious one. But that's going to be, that's keeping the record of all your on time or late payments. So first and foremost, which this one's the obvious one, make your payments on time, right? No matter what, make your payments on time. You don't want to have lates because that's going to have the biggest effect on your score. But this one here is the tricky one. Those of you seeing it, the next one is 30% of your score is your available credit, which means your credit limit minus the amount that you owe for each account. Okay, so for example, I'm going to just use a round number of $1,000. If you owe $1,000 on this card and you owe $900 on that card, and then say you have 3 cards, I'm going to just use the $1,000 on all 3, just so it's easy for this conversation. And on each of them, you owe $900. You're pretty much maxed out. We would be consider that in our normal person's terms, that I'm maxed out on my credit card debt. Well, that's going to have a 30% negative effect on your score. That's a huge deal because that's a big chunk of your score is going to be based on that. So, the old saying, looks like you're, robbing Peter to pay Paul all the time because you're maxed out on all your debts everywhere. You're just pulling money from everywhere else. And that's what it looks like to anyone that's going to lend you money. It's like, wow, this guy, man, he's overextended on everything that he has. What is his chances to repay me, right? He's going to be overextended on me. He might have a hard time getting me paid. That's going to reflect on that score that comes out. And that's a big thing. And I'm going to give you the solutions in a few minutes on how to gauge that to boost that score up as fast as possible. The next thing up is we have a 15%. This one's a little bit unique in the sense that most people don't think of this, because I'm going to give you a few real life scenarios, is the length of the credit history with that card. So for example, let's say you are 35 years old and you had a credit card since you were 22, but when you took it out, it was one of the first cards you took out, and it maybe didn't have the most desirable interest rate at the time, and maybe there was a fee associated with it, but you kept it. And now somebody comes along and says, I'm going to give you a 0% interest rate. This is the best card since, sliced bread. And you say, you know what? I'm going to pay off this card. I'm done with them. I'm done with this credit. The interest rate they gave me, I'm shutting that card down. Well, that 15% now that they've been measuring you on for the last 15 years or 14, 13 years is now gone because it's no longer there to measure you.
Well,
so that
15% is not insignificant.
It's not. So, you're looking at, if you got that 740 score and you close that card out, you might now be a 715 or 700, just from closing out that card, which now could cost you hundreds, thousands of dollars in time over term, over a loan. So these are the things you want to, if you have cards that you've had for a long time that you had good history with, keep them open, keep the balances low, especially if you're in a season where you're looking to make some big purchases that are going to be measured by your credit. So that is a big one. And now the other two are, they seem small, but they're really not. Again, these are things that can have a massive effect. If you have that 740 score and you drop by 5 or 10 points, well, it's going to cost you money. So one is the number of inquiries that you get. So it records every inquiry logged when you're applying for new credit. So every time you get a hit, there's a small little hit to your credit because, again, the reason why I like to always give people reasons why is that it looks like you're always looking to borrow money. You're borrowing money, borrowing money. So they're measuring like, man, this guy's always got 10 inquiries in the last 2 months. What is going on with this guy that he's looking to get all this money? What is this all about? So it affects the score. It goes down a little bit.
Now,
Also,
one exception to that, though, when you do a mortgage inquiry on your credit, you do have a certain length of time that, like you can, let's say you're with a lender, maybe a small bank or something, and you're not very happy with the programs, you have the ability to check with another lender without, getting, I guess,
hit
punished for
multiple
that.
times. So that's a very good point, Mindy. So, you know, even though when I say these individual inquiries, it could be like you went to the Macy's store and
Right.
well, you're going to get 20% off. So, apply now. Then you go across the street and they give you some other wacky offer. You're on a plane and they say, we're going to give you 80,000 free miles. Just apply for this credit card. You do that because you think, oh, I want those 80,000 miles on my account. So you do that and you're doing these things, and kind of consistently within the same time period. Well, it's going to have a negative effect. But when you go shop for a car or a mortgage, actually encourage you to go shop, right? Encourage you to go try to get the best deal that you can. So you're not penalized at that point. The mortgage is 30 days, right? So you can go and shop your heart out and have multiple companies pull your credit. Now you're going to still have that one inquiry. The first inquiry is going to still be an inquiry because someone pulled your credit. So you're going to get hit for that one. But the remainder ones during that time that you're shopping and trying to get a competitive bargain, you're not going to get hit for it unless you have someone pull your credit this month and then you don't do much with it. And then like, oh, I'm going to go apply at this other place. And then they pull your credit the next month. Well, that's going to be 2 inquiries.
So that magic number is a 30-day window.
30-day. And I don't know what it is for car shopping, but it's somewhere the same thing. They give you a very good size window to go out there and exercise your right to shop without being penalized for doing so. I mean, again, consumer rights. We want people to go out and get the best deal that they can without having to feel that they're penalized for it. So the next thing is that the next 10% bucket is on number 5 is the types of credit. So what is your balance of overall credit? Do you have, 20 credit cards? Or do you have like 10 car loans? Well, that's not going to be it's not going to be looked at as strong as it would if you had a balanced credit scenario. Maybe you have like four credit cards, maybe a vehicle or 2 and a mortgage or 2 mortgages. You know what I mean? So you got a balanced portfolio where they can look at you and they're going to say, this guy's balanced individual. You know what I mean? He doesn't have 40 credit cards going all at once. He's juggling all this different stuff. And it's not that much of a hit, but again, 10% could mean the difference between getting, a 0.25% better in rate or more, which could then result in hundreds and hundreds and hundreds of dollars as
Yeah,
we go.
that's huge.
It's a big deal. So I think, what can we do? Solutions, right? What can we do to increase those scores? So you're looking at your Credit Karma, you're looking at your Expedia, Experian, or whoever you guys use, Equifax, whatever card service gives you your scores. You're like, I just don't know what to do on how to increase and improve my credit score as fast as I can because I want to really get into the spring market. I want to get out there and start shopping. But again, I want to take advantage of a better price.
Well, Chris, so you're as a mortgage lender, I don't think a lot of people know about this because I actually didn't until I started working with you. But as a mortgage lender, you're able to run something called a what if scenario.
Yep.
And because you're able to do that, what could be, it's always, obviously it's individual, right, into each individual case, but what could be some fast things to get that credit score up. So what's the what if scenario and how does that guide you?
So these simulators, they're really sophisticated and they're right on target, because we've over the years, there's many other lenders that probably offer the same thing. And I've always been good at fixing credit even before we've had simulators. So I've been doing this for the last 26 years of my career, has helped their score up quick in order to get the better rate or even qualify for a loan. So now with technology, what I can do is I can look at a person's credit report and I can say, okay, what if we pay this card down to this? What if we pay this debt off? What does that score look like immediately? What does that score, if they do everything they can, what does that score look like in a month from now, 2 months from now? Maybe it might take 3 months, but at least I can say, listen, Mr. or Mrs. Client, if you do this, this, and this, in 2 months, your score should be this if nothing else changes on this. I mean, you don't open up new credit, you get your cards to do this, you pay off this debt. And if you do these things, you'll be in a place to either qualify or you'll be in a place to have that 740 score if you do these few things. So those are things that are helpful while you're in the process. I'll give you some practical things that you can do without me pulling your credit today that can get you on the right path. So then when you do have someone pull your credit, whether it's my company or some other company, there might only have to be a few tweaks you'll have to do, or if you did a good job, you'll do nothing, right? So we'll just start at the top, right? So you got a few things that you can really do that are simple. One is pay your credit card balances strategically, right? So that I always say, if you can keep your credit cards at a 30% utilization, you're going to get the highest scores on your credit report. So, if you owe $1,000, if you got $1,000 limit, we want to just keep that card at around 300.
So
Right.
30% is that magic number.
That's the magic number. And I can tell you one thing, you don't want to just pay them to zero. And here's the reason why, because I've had people that paid cards down to zero and their scores actually went down. And the reason why is because when you pull your credit, it's a snapshot in time. It's what your credit looks like at that moment. They don't realize if you use the card all month, because when you hit send and you get that report, it's based on where it is right at that time. And if it's at zero, there's nothing to measure you on that card. They just know that you owe $0. So they don't know if you owe $0 for a month or 2 months or 3 months. It's just zero. So I always tell people to keep a small balance on your cards. Don't pay. I know you like to pay them off, but just keep a little bit of a buffer, even if it's $100, depending on the utilization limit. Just keep somewhat of a small balance on it. That way, if there's always something to measure you. But you want to make sure that those balances are low. So when they are reported in the cycle ends, that you're keeping those scores at where they need to be. So here's a couple different things that you can do in order to get there. So a lot of times, say you have $10,000 in credit card debt and you got these cards that you owe $5,000 or a $5,000 limit and you owe $4,000. Well, most people don't have an extra $3,000 sitting in their back pocket to go pay down the card. And we get that and we understand that. So along with giving and paying as much as you can down on it, one of the fast track things that you can do is call and try to increase your limit. All right. If you can increase your limit, say if you have that $5,000 limit and you increase it to get it increased to $10,000 or as much as they can give you, again, you're going to make that spread a little bit different. And obviously, being at 70% is better than being at 90%.
So in some instances, it might not necessarily be debt load per se, but more of what the debt is compared to what their limits are.
Correct. And you're going to want to do some things you can set, set your calendar reminders to log in and make your payments. So you're not paying, there's a lot of people that I work with that pay their credit cards every month. They use them, max them out and pay them, but maybe they're not paying them. They don't have an alert that they're paying when they're reporting.
Uh-huh.
So they're paying it off, but when it's reported, it's at the point where it's still maxed out. So you want to just start putting some alerts in your phone if you're that person that pays them every month, uses them, gets the points, and then pays them. Just make sure that you know when it's going to report and you make in that payment posts prior to them posting it. So that's going to be helping you. Um,
So
and
let's say
that's
so let's say that you've got someone who doesn't have, maybe they just got a credit card last year or just got one and they don't have a long history. What can they do? Maybe debt load's not an issue for them.
Yeah, so there's a few things that I always tell new people. My son's going to be 18, so I've been putting him on some of my good cards that I have low balances on as an authorized user. Um, so I can fast track his credit scores. So when he starts to get his own credit cards, he's already got to establish some credit based on me teaching him. So as parents out there, I would definitely encourage you to, put your kids as they get into high school and college, put them on as an authorized user on some cards that you use, but you're not overextended on. Because again, your debt is going to be their debt. So I always say when you become an authorized user on a card, don't get put on a card that someone owes $20,000 on, because now you got to assume that debt as if it's yours too when you're going to apply for a loan. So
Mm-hmm.
things I always tell people to look for if they have somebody like a family member that's willing to allow them to be an authorized user on a card, it's usually a family member, is make sure that the balance is low and they've had the card for a long time. So they get maximize and optimize the benefits of being an authorized user. And again, some of these kids, like my son, doesn't have the cards in his hands. If he's got one card that we give him for like his gas or his emergency here and there, but these are just little things that you can do to help. People can call this credit piggybacking, if you will. And again, it's usually, go to your mom, your dad, your brother, your sister, someone in your family member that trusts you and loves you. And think about it. If you don't have anybody that trusts you, maybe, and you have bad credit scores, you know what I mean? So there's an obvious reason why the bank may not want to lend you some money, right? So that's a different conversation that you might want to look in the mirror and figure that stuff out. But
Well, now that is different though so you've been doing this for so many years and you've seen so many scenarios. I mean, we're sitting in a recession right now, right? The person who's chronically bad, who needs to have a self-talk, that's different than someone who fell upon hard times,
yeah,
or someone who, the economy went haywire and then all of a sudden they've got this new debt because inflation was at 9%. So coming to your team, you don't pass out judgment in terms of what credit scores are, because there's just so many things that,
there's so many things that people go through hard times, and a lot of times, I've been in with clients where we can write some explanations. Life happens, and sometimes there's exceptions that are made. But I mean, per the conversation that we're having, is I want to give you and arm you with the weapons to
yeah.
put yourself in a good place if you can. If you can't, then what we do is we try to fix the problems that you had and get them off your credit report as fast as possible, which a few of the things that we will talk about is when you're disputing some things on your credit report. I would absolutely 100%, if you're paying it, even if you're paying it for less than full, I would ask for a deletion letter. If somebody gives in a deletion letter and I do what's called a rapid rescore, I send in that documentation that says, all right, the debt is paid and it's a deletion letter, they'll take that debt off as if it never existed. And that will have a very big, and I can run that through the simulator as if I got a deletion letter, as if that debt was never there. And it was taken off because they made a deal and they took some money from you, or you paid it in full and they gave you a deletion letter, your score could go up 50 to 100 points just like that. I mean, immediately. So if you have collections on there, obviously we want to get rid of them. How you get rid of them is completely up to whatever you have for money. So if you can have a lot of these collections, then you're gonna have to make some phone calls and you're gonna have to work through it. And that's the part that consumes some time. But I can tell you, I've had hundreds, I can literally say hundreds and maybe even thousands of people that we've worked with over the last 20 something years that, we're so glad that they went through it to finally get that behind them and fix some of those issues. Because there's some people that they have like a 590 score because they let a old girlfriend or boyfriend, buy a cell phone they didn't pay. And now they got this $200 collection on their account that's dragging their scores down into the 500s. And I'm like, guys, it's $200. Just go pay it.
Also
Right?
cause to reevaluate your life choices.
Yeah, just go pay it. You're not going to get it out of them. You're not,
Yeah.
it's going to cost you thousands because you're going to get a bad rate because of your score. So go take care of these things and always check on it. I think it's important for us to do that. Also is for those newer people is use a secured credit card. If you have no other options, you have no one to put you on as an authorized user, you can go to some of these banks or you can even go online now and you can find somebody that will do a secured credit card. So maybe it's $500, you give them 500 and then they lend you. The only thing you want to make sure is that they're reporting it to the credit agencies.
Yeah. I think these are all great tips for people in general, but if someone is at that point where they're ready to step into home ownership and they're worried or not sure, a conversation with you and your team, I think can settle a lot of fears and a lot of worry because you can look at the individual case. You can just with a conversation point them in a pretty good direction of where to go. So instead of fretting over it and trying to figure it out yourself, start that application and chat with you. I remember several years ago when I went to buy my first home when I was like 26 years old, and it came up from like years prior that I had an $8 copay to a doctor's office. I didn't know I had because when they sent it to me, I had moved apartments and I never got it. It went to collections, $8. And I was like, what do you mean I have an $8 copay that was dragging down?
The matter was $8,000, right? It was always did the same damage as an $8,000 debt would have.
I know. I mean, it's funny. I laugh at it now, but I remember when that came up, I was like, really? Like, just the stupid little things. So, well, Chris, thanks for this info. This really is kind of pulling the veil back on the credit card mystery, or the credit score mystery, I should say more specifically. Yeah.
If anybody on here that listens, and you have any questions, call. I love educating. That's the part I really love about what we do here. So even if you're not looking to buy and you just have some credit questions, I'd be more than happy to, jump on a phone call and kind of, even if you wanted to meet with me to look at your Credit Karma credit and I could just see something, be like, okay, I would do this, this, and this. Call me, message me, find me, follow me on YouTube and Facebook and all this good stuff. And then message me on the backside of it and set some time up to talk with me. I'm pretty accessible as far as my, I think, LinkedIn and all that. I have my phone numbers and all that stuff. So you can reach me fairly easy. So would love to chat with any of you guys on any of these topics at any time. So thanks again, Mindy, for jumping on here.
Yeah, well, thanks for everyone for tuning in. If you want to rewatch this or re-listen, you can find this on whatever podcast platform you prefer. And you can also find us on YouTube. On YouTube, we are almost at 100 subscribers, which is like a huge milestone in the YouTube world. So if you go on YouTube, don't forget to like and subscribe so that we can hit that 100 subscriber mark there. So, Chris, until next week.
Yes. Until next week.
Everyone have a wonderful weekend.
Happy Easter.
Bye-bye.